Thank you. I think we have, somehow the audience has reduced, but it's a very interesting session. We as actuaries have been trying to model various types of distributions for different risks. And we feel that, all the distributions may not fit and we've tried to find a relevant distribution for that particular situation. But we have recently realized that sometimes the machines are doing a good job in modeling those patterns and trying to understand and represent the data much more meaningfully. And that's where but if you see all the work which is being happening in this area, it largely relates to very static models. That means if we take a logistic regression or a decision tree or a random forest model, we have various parameters, but then the weights assigned to those parameters are static in nature. And then we try and, but the real world is changing so dynamically that we need to incorporate the changes whereby, and update not only the parameters, but also the weights for those parameters. And that's where this dynamic model or the concept of dynamic model comes into place. We have two accomplished speakers here. I would like to talk a little about them, but before that, I just thought I'll introduce this particular topic as to why do we need this dynamic model. I mean, if you see some of the changes and the real flow of information, that is so fast and so, we call it a VUCA world or a BANI world. So that means the information is flowing so rapidly, and we need to incorporate that to make the models take a better decision. Now, but as I discussed, that most of the models which we produce, they are very static in nature. At least the weights are static. We allow for the parameters to be updated, but then the weights remain the same. But then is there a way to make the models more dynamic? And can the deep learning models be made more dynamic, the machine learning models be made more dynamic? And that is the topic which we have today. We also struggle when we try to make these models dynamic and incorporate this real-time information. We feel that the energy required or the computational power required is too high. We have this GPUs and TPUs, and you see NVIDIA stocks soaring because everybody is running for those computational power. But can we manage these hundreds of layers of neural network in a much more efficient manner, whereby can we reduce from 100 layers to 2 layers or 3 layers? And that's where I think we'll have Ashna and Erik talk about that. I know these are very important challenges which we need to overcome, because this requires not only high computational power, but a lot of energy. And a lot of energy gets wasted in trying to update the models. So can we update the model without fully updating all and retraining the whole model? That's the objective of this session, whereby is there a way to manage the real-time information, incorporating the real-time information without really requiring to update and retrain the whole model? And that's where you will see some the very interesting discussions, and there are 3 important areas which will be covered. I think we'll be talking about some of the machine learning models and how the mathematical algorithms can be used to make them far more efficient, far more adaptable and dynamic, and also use lesser computational power. So I would like to invite Erik and Ashna to come and start this presentation. I think both are very accomplished in their own way. Erik heads the APAC region and based out of Hong Kong. He's been with KPMG for many years, and it's like I think he's been trying to help people on the life insurance side, general insurance side, on the entire insurance practice actually he's been heading. Ashna is also a very young actuary working in this area, in this domain. She's been helping life companies on the IFRS side in India. I think we have really 2 accomplished speakers for the session, and then we'll open it for the questions at the last. So kindly bear with us. There are 3 interesting models coming up. Welcome, Erik and Ashna.
Very good. Thank you very much for that introduction. Let's move on to slide 1 on why is this relevant. Take a little step back before we dive into 3 technical complex things. For me, this is about the massive journey that the sector has gone through, I would say, in the past 5 years. If I look at my clients around the region, COVID has been a massive accelerator of innovation and of technological change. Companies had to do it. They lost connectivity with their clients. They had to massively transform the front end of the business. A lot of investment in distribution, probably less investment in the back end of the organization. At the same time, you've got many new requirements. You mentioned IFRS 17, we got risk-based capitals around the region, and that requires more computation, more complexity, and there is a massive pressure to make that work within the times that companies are given and to make it work within the right amount of cost. Because there's been a lot of investment in the past 5, 6, 7 years, but there's not been as much growth. So there is a lot of pressure around the region on cost as well. So at the same time, on the one hand, there is a lot of pressure on investing more, digitizing the rest of the organization beyond the front office. But at the same time, there's a lot of pressure on cost. So there's a lot of drive on demonstrating value, demonstrating ROI on investment, and that means you need to think differently. And I would also add to that that within that time frame, the technological capabilities have advanced at a speed like no one could have predicted. So if you put all that together and you want to make change, you need to maybe think differently, and you maybe need to think in terms of approaches, techniques, models, technologies that haven't been used as much before, but might actually provide an answer to things that need answering. So that's the backdrop of selecting these three. We probably could have selected 5 or 10 if you had it your way, but we're limited to 3, just maybe to get the mind going, get you thinking about, well, actually, what is the art of the possible and what are we not doing that might be around the corner that we can actually use to make our lives better, give ourselves better outcomes, free up capital, maybe design better products, be more meaningful to our customers, and therefore be more meaningful to our societies. That's the backdrop. Ashna, yours. The floor is all yours to cover those 3 topics. Thank you.
Thank you, Erik. It's great to be here today. Let me just start off by asking you a quick question. Why did the actuary break up with the static model? Because we were stuck in the past and refused to adapt. Okay, so as actuaries, we rely heavily on our models. They help provide us insights, they help us manage risks, and they allow us to make informed decisions. But here's the challenge. The times around us are evolving faster than ever, and static models just won't be able to keep up with the pace. So today, I'm going to introduce 3 game changers. This is, okay. Advanced statistical models, a machine learning model, and why isn't this working? Sorry.
Where is technology when you need it?
Advanced statistical models, a machine learning model, and a way to boost computational efficiency. So together, these 3 things will help us transform the actuarial landscape. First, I'm going to talk to you about Kalman filters, which is an advanced statistical model. And I'll speak about this especially when it comes to tailoring the mortality assumptions. Next, I'm going to talk to you about recurrent neural networks, which are a way for us to understand and model policyholder behavior. And I'll speak about this especially when it comes to lapse assumptions. And our last topic will be the sparse grid method, which is a powerful solution to help us overcome the challenges we face when it comes to stochastic modeling. So together, these 3 aren't just technical advancements. They're a way for us to shift into a more data-driven and adaptive actuarial practice, and it'll help us move towards a more resilient and inclusive insurance industry as we head towards insurance for all by 2047. This is struggling with this. Can you change it from that side? Okay. Okay, so I'm going to talk about Kalman filters first. So what are Kalman filters? It's a state space model, which means that we have a latent hidden state, and as we get more observed values, we'll be able to blend it with our prior estimate. A Kalman filter, it's called a filter because it helps us filter out noise. So when we're looking at observed values, the reason we can't immediately adapt and involve them in our assumption setting is because they always come with a lot of noise. So a Kalman filter will take into consideration process noise and observation noise, which are typically the kind of noise we see in our models, and it'll filter it out in a way where it'll be able to blend our estimates using these observed values and capturing the trends in real time. So before I get into how this works, I'm just going to show you what all we'll be able to do with Kalman filters. So Kalman filters will help us for mortality estimation. It'll help us refine these estimates as new information becomes available. It will help us adjust the weight. So it gives a certain weight to the prior estimate, and it helps us take in new observed values and adjust the weight accordingly based on how reliable these new observed values are. Okay, so here's the most interesting part. It will help, we can take a wide range of data. So currently, our assumption setting is very limited. We look at age, gender, smoker status, static, very few assumptions. But Kalman filters, since it's a state space model, it can capture multiple states. So just to paint you a picture, it can take mortality based on financial sophistication, education, income levels. Then imagine we have data in different states of the country which vary based on the climate, AQI levels, exposure to like natural calamities, all kinds of data you can think of. At whatever level we're looking at mortality, we can consider all of that all at once in our Kalman filters. It can handle non-linear shifts in mortality. So if mortality for a certain group accelerates or decelerates in a non-linear fashion, that can also be considered in our Kalman filters. So I don't know if everyone here is aware about cohort effects when it comes to setting mortality assumptions. So the cohorts, there are cohort effects, and a very significant one is the one we observed in cohorts that were born after World War II. So these cohorts experienced better mortality rates. They were lower mortality because of the fact that post-World War II, we were coming into in a time where there was more education, less exposure to chemicals, etc. So these cohorts actually were a little different from previous cohorts. And this is something Kalman filters will be able to capture, and which our traditional approach will not be able to capture when it comes to something like COVID-19, because with COVID-19, we aren't aware about how it's impacted that specific cohort that was born in that, the people born during COVID-19. We don't know if because they were not exposed to a lot of they weren't exposed at a young age, we're not sure if that's going to improve their mortality or make it worse. So Kalman filters is actually something that might be able to capture our cohort effects in a better way than we can. It uses probabilistic mortality estimates. So, and we can use incomplete data here. So that's also interesting. So in parts of India where we have low insurance penetration and we don't have enough data, that can also be fed into our Kalman filters. So all in all, we can take all kinds of data and incomplete data, new data, everything can be fed into our Kalman filters, and we can come up with a more realistic assumption. It also reacts immediately. So during COVID-19, what would have happened is, if there was a spike in claims suddenly, first it would have picked it up as noise in the data. As and when we move forward into the year, it would have adapted based on the fact that this isn't just noise, there are higher claims, and it would have adjusted the mortality assumption accordingly. So this is how the Kalman filters work. We have an initial mortality assumption, which feeds into our prediction step. Then it moves into our update step, where new observations will come in, and it will compute a Kalman gain. So this Kalman gain is a weight that it gives to the previous estimate and the new estimate, new observation. So based on how reliable this estimate is, it'll be able to give higher weight to the new observation. If not, then it'll work based on the previous estimate. So if we have incomplete data, for example, over there, it'll give higher weight in those situations to the previous estimate or the way things are. And as the data becomes more reliable, it'll be able to balance this Kalman gain and give it more weight. Yes, so noise. If there's process noise, if there's observation noise, both of this gets filtered through our Kalman gain. Where there is more noise, it'll give less reliance to that data point. Where there is less noise, it'll get more weight. So the Kalman filter is built in a way where it understands that there will be noise in the data and keeps that into consideration when it's setting the estimates. So here are some fields where Kalman filters are already used. So it's about time we also join the club. So for example, I can paint a picture for you how GPS and navigation works. In GPS and navigation, Kalman filters are used in a way that, for example, if we have a road that cuts like this, and the Kalman filter picks up an observation that's here. At first, it will assume that that's a noise because it assumes that the road is over here. But as and when it picks up more information, more data points that are in a different location, it'll understand that there might be an inner route or a smaller road that's not accounted for. So that's how it works in these fields, and it's something that we should actively consider so that it can make our lives easier. Okay, so the next concept I'm going to introduce is recurrent neural networks. So this is our machine learning innovation. Recurrent because it's moving in a loop. It's taking past information and moving forward. Neural because we're talking about something that has memory. Machine learning can be leveraged in a way where it can capture a lot of information and it has a memory of its own. Network because it is based on the fact that what's currently happening is determined based on everything that's happened in the past. So at time t minus 1 till time t0, consider all of that to determine what is happening right now. Now, how can we use this for lapse assumptions? The problem that we are not addressing is that we think lapse assumptions are static. We think policyholder behavior is static in nature. We base it on premium paying mode, distribution channel, age, gender, very static assumptions. And we assume that that's what it's going to be like throughout. But policyholders change with time. And there are certain things that could determine how they're going to behave in the future. So what these neural networks will do is consider all of that information before they assume what's going to happen next. And it'll take a wider range of data. So just to paint a quick picture of what data we're currently sitting on and not utilizing at all when it comes to setting lapse assumptions. We're not looking at policyholder information, policyholder interaction with chatbots, emails, when they call and ask customer service questions. We're not looking at their website activity, how much time they're spending on the website checking their policy details or looking at the FAQs. We're not looking at if they're saying anything about us on social media. We're not looking at if they change their payment method, if they miss a premium payment, if they pay a little late. We're not looking at all that data. All of that data is feeding into their probability of potentially lapsing a policy. So we're sitting on this data right now, not using it at all, and recurrent neural networks will be able to use this to give us this information. There are short-term ones and there are long-term ones, so we can look at the longer the term is, obviously it'll be higher demand on our systems, but even short-term neural networks can help. For example, if a policyholder misses a premium payment, there's more higher possibility of them missing the next premium payment. So that's just a short-term RNN. We can also have longer-term ones where we're looking at over 5-6 years, their website activity, if they're decreasing their interactions, and based on that, we can check, we can understand better what the likelihood is of lapsing. So basically, just to wrap it up, we need to get more granular because we're using static assumptions and we're not leveraging all the data that we currently have. And this is what holds us back from giving more personalized offerings as well to policyholders. So this is how it works. We have the policyholder action at time t0 to t-1. It feeds into our recurrent neural network along with any static policyholder data. And it'll help us determine what can actually be happening at time t in a more holistic way. So it'll evolve over time because policyholder behavior evolves over time. It can identify patterns that slowly unfold over time, any temporal patterns. It can help us, we can use website activity and information as such that was not currently being used. We can detect any emerging risks. So it's not just about setting the assumption. This information can help us stop a policyholder from lapsing because of the fact that we understand that they're heading in that direction. We can use unstructured data, sensory data, phone recordings, information like that that's currently just going unutilized. And we can have it short-term basis, long-term basis, whatever works for us, but we can leverage these RNNs better to better understand how policyholder behavior is changing. So I've spoken about 2 game changers so far, and they sound a little computationally intensive. Now I'm going to talk to you about a method that we have, which is our 3rd game changer, that will help us use stochastic modeling in areas that we haven't before, because we're not going to be burdened by the fact that it's computationally very intensive. So it's called the sparse grid method. So just look at these 2 diagrams. I'm sure you can tell which one is the more computationally intensive one. So to explain what's happening here, when we're looking at a stochastic model, as we add dimensions, the intensity of it increases based on the fact that the function or the model has to be computed at each grid point. So a grid point is just representing the area that the function needs to calculate. So if by 17 by 17 grid, if we're looking at 17 different dimensions, as we add more dimensions, we'll have the burden on the systems will increase. When we're looking at a sparse grid method, what happens is the grid points decrease. So we look at a fewer places where the function will be evaluated, but we'll be able to get accurate results or very close results. So how this works is based on 3 factors. The first one is called the Smoljak algorithm. So what this does is it asks us to fix a refinement level. So let's call this refinement level Q. The higher Q is, the more grid points it will run at. The lower Q is, the lower grid points it will run at, but there'll be more error. So we have that leverage. We can control the amount of grid points that we're running based on the Smoljak algorithm. So we can limit it in a way where the error term comes significantly down, but just not to an extent where it just becomes more and more computationally intensive. Then there's something called the hierarchical basis function, which means it'll select grid points based on those grid points that will help us improve the accuracy of the results and cut down any unnecessary calculations. So for example, areas of the function that are smooth will be skipped over. If we have a grid point like a function a comma b, and that's equal to what we get at function b comma a, it won't run that twice. It'll run it once because it knows that there's no point running another grid point, considering the fact that we'll get the same result. So it'll efficiently cut down the number of grid points that we're using based on what will lead to more accuracy. Then we have adaptive error estimation, which means that it'll add grid points in the regions where there's higher error so that we decrease the error. This is a study that was done by Florida State University, where they solved a partial differential equation, and 4,000 simulations were required for a sparse grid method to arrive at the estimated value with a considerably low error, while a Monte Carlo simulation took 10 lakh or 1 million simulations. So this is a true game changer, because this is what limits us in the industry when it comes to stochastic modeling. So I've given you two helpful ways to improve our assumptions and a way to make sure that it's not very computationally intensive.
Brilliant. Thank you. All right, with that, let me bring it together as we work towards a close. I mean, as a starting point, you've set yourself a fantastic ambition, I think, as an Indian insurance industry to insure 1 billion people by 2047. And I think in order to get there, there is a massive opportunity and a massive responsibility for the actuarial profession to help get there. And I think part of that is using the abilities of the world around us better. Anticipate technology, use technology in a different way, and be brave enough to use technology in a different way than we've done in the past. As I said, I think these three probably could have been 5 or 10, and I'm sure that next week or next month or next year there'll be 10 new ones. All of them, I think, will add up to better answers, better assumption setting, faster calculation, reduction in capital if you get it right, ability to free up capital to invest, design new products, design better products, be more relevant to policyholders, be more relevant as an industry, and ultimately get to that objective of insuring 1 billion people by 2047. So I hope this sparkled the imagination a little bit. I hope that there'll be another 5 or 10 of these great ideas next year. And with that, I've got a few minutes left for a few questions, and I will hand it back to the chairman to moderate that.
Please, thank you so much. I think, it was really, really good to, understand these concepts, because I have been feeling that, as actuaries, perhaps we were, supposed to be, the pioneers of the new models. And I think, I don't know how many of you have heard about Jim Simons. He was a professor at Stony Brook University, a mathematics professor, and he created a company called Renaissance Technology. Actually, he quit his job as a professor there, as a maths professor, MIT undergrad on mathematics. And with some few, other professors, he started a firm called Renaissance Technologies, and they used to model the stock patterns through mathematical models. And, he created a 66% CAGR for 30 years. He never shared his, the details of his mathematical model to anybody, I mean, including SEC. But I feel that, the same things can be now modeled very, maybe much more efficiently by the machines. The mathematical models which he used was to identify the patterns in the stock prices on the asset side. And, he could generate that kind of phenomenal return. He was like printing cash, every year. So it's like 66% CAGR, if just to make you interested. I mean, he became the 25th richest person in the world. So these mathematical models are becoming far more efficient if we make them much more dynamic, because now, you see, the reading of the qualitative information which is coming through the reports of the companies, they all can be factored in. Whatever we read about the medical reports, everything can be done by the machine. So earlier only quantitative parameters were getting modeled, now qualitative parameters are getting modeled. But then there's too much of information. And that's where Ashna, I think, was trying to say that if there's so much of overload of data to be analyzed, we need more efficient algorithms to manage the data. And I think that's where, instead of the Kalman filters can perhaps help, we don't need to retrain the whole model. We can just, the Kalman filters can really help incorporate the additional information very easily. Similarly, when you have the sparse grid method, perhaps you don't need the whole grid. Actually, you need, you saw 10 lakh model points versus only 4,000 model points. So those innovations we really need, because otherwise, the whole exercise may become computationally inefficient, actually. We may not have the computational power also to handle it. So I think, it was really very interesting, but I'll open it for questions, if any. Yeah. Yes.
Just a comment. So we use the Kalman filter extensively because we have to know where the cars are. at Uber. I would say that, that there's a certain thing I would caution about using the Kalman filter the way that was described, and that is sometimes you're going to get a data point that looks weird, and you're going to throw it out, right? Because Kalman filter will say this is weird. But then later on you get another data point, and you say, no, wait a sec, that wasn't noise. And so your Kalman filter has to be bidirectional, right? You need this GPS point, the next GPS point, and the next GPS point to see if this one actually was real, so it needs to be a bit bidirectional. Let me bring it home. COVID, when COVID hit, you look at the data point and you go, gosh, I don't know what's going on. This is an outlier. Maybe we throw it out. And the Kalman filter could actually throw out data that you need because the next point you say, oh my gosh, COVID is real, right? And so I would say look bidirectionally on the Kalman filter. That's my comment on that one. The other stuff was really great. Thanks.
No, I think it's a fair comment. I mean, I think the filter, I mean, the noise has to be factored in properly, and maybe the long-term trend is changing or not, we have to understand whether it is really impacting in the short term, just the immediate impact, or is it really impacting the whole trend itself. So I think it's a very point.
Totally.
Yeah.
Thank you.
We're up for time.